You're listening to Uranium Spotlight Podcast, sponsored by PurePoint Uranium Group. If you're following this market closely, you'll want to explore Behind the Curve, understanding when and how the uranium market turns, a new white paper that shows investors how to spot the cues that come before uranium prices move. And now, your host, Chris Frostad.
It's Tuesday, January 6, 2026. And this week on Uranium Spotlight, uranium prices surge through year-end. Governments tighten control over supply in Kazakstan and Niger. India clears the way for private nuclear investment. And Denison Mines moves the Phoenix project to the edge of construction. The uranium spot market ended 2025 and opened 2026 with a decisive move higher. The spot price closed this past Friday at $82 a pound, up sharply from $77 a pound just before mid-December. The $5 increase occurred over a period when market participation was thin, formal commentary was limited, and transaction volumes were not unusually high. Yet prices continued to advance steadily, pushing through levels that had capped the market for much of the fourth quarter. Month-end pricing showed spot values moving into the low 80s by late December, while long-term prices held firm in the mid-80s. Forward prices continued to point to materially higher incentive levels several years out. In other words, this was not a short-term dislocation. It was a continuation of the same structural tightening that has been building quietly all year. What makes this move notable is not just the magnitude, but the manner in which it occurred. There was no single catalyst, no headline contract announcement, and no visible rush of speculative buying. Instead, prices moved higher because available pounds were limited, sellers remained disciplined, and buyers were increasingly unwilling to wait. Historically, uranium markets tend to move first when participation is low. When prices move under these conditions, it often reflects a market that is tighter than most participants realize and one that is no longer waiting for confirmation before repricing. For investors, the key takeaway is that uranium entered 2026 with clear upward momentum driven by fundamentals, not excitement. Moves like this tend to occur before broader recognition sets in. The price behavior we're seeing now is one of the cues discussed in Behind the Curve, the white paper that shows investors how to recognize when uranium's real move is taking shape. You can download it now at uraniumspotlight.com. Over the past several weeks, Kazakhstan introduced one of the most significant policy shifts the uranium sector has seen in years. A new subsoil use law signed in late December fundamentally changes how foreign companies can participate in uranium projects across the country. Under the revised framework, any extensions to existing uranium joint ventures must be structured with the state-owned Kazatomprom owning at least 90% interest. All new joint ventures going forward must give Kazatomprom a minimum 75% ownership from the outset. Even more consequential, companies that discover uranium in Kazakhstan are no longer guaranteed rights to that discovery. Any such discovery must be negotiated with Kazatomprom, with the discoverer required to relinquish at least 75% of the project. This tightening of control comes alongside continued international engagement. Kazakhstan signed a civil nuclear cooperation agreement with the United States focused on education and advanced reactor technologies. It also announced new uranium supply arrangements with Japan's Kansai Electric, extending a partnership that has existed since 2006. Kazakhstan produces roughly 40% of the world's uranium. That scale gives it unique leverage over both supply timing and commercial terms. While the country remains open to doing business with Western partners, the new rules clearly prioritize state ownership and reduce the economic upside available to foreign participants. For investors, this matters because it reduces the pool of future flexible supply. Even if headline production volumes remain stable, fewer pounds will be developed, financed, and brought to market under competitive terms. In a tightening market, control over supply is often as important as supply itself. If Kazakhstan represents a tightening of terms, Niger represents a clean break. Since the military takeover in mid-2023, Niger has moved aggressively to assert state control over its uranium sector. Over the past several weeks, the country signed an agreement with Uranium One, a subsidiary of Russia's state-owned nuclear group, Rosatom, granting it permission and government support to explore for, develop, and build new uranium mines. At the same time, Niger has nationalized or otherwise taken control of several major uranium assets previously operated by Western companies. Arbitration proceedings are ongoing, but shipments of uranium have already moved out of the country despite international court orders restricting such activity. With one notable exception, Niger has effectively exited the orbit of Western uranium producers. Unlike Kazakstan, which has tightened control while maintaining optionality, Niger has aligned itself decisively with Russia and its allies. That choice removes existing and future Nigerian supply from Western utility planning and further fragments an already segmented uranium market. For investors, this matters because geopolitical alignment is now directly shaping supply availability. Pounds that were once considered accessible to global markets are increasingly constrained by politics, not geology. India has also made a major move over the past several weeks, but in the opposite direction. The country passed and signed into law its long-awaited nuclear reform bill known as Shanti, bringing India's civil nuclear liability framework in line with international standards. Previously, India's liability laws effectively prevented private and foreign participation in its nuclear sector by placing accident liability on reactor designers. The new framework removes that barrier and opens the door to private capital, foreign technology providers, and large-scale investment. India has stated a goal of reaching 100 gigawatts of nuclear capacity by 2047. Today, the country operates roughly 8 gigawatts across 23 reactors, with several more under construction. Even with those projects underway, India has a long path ahead if it is to meet those stated objectives. The passage of Shanti does not guarantee success, but it removes a critical structural obstacle. Without this reform, India's nuclear ambitions would likely have stalled. With it, investors can now take India's long-term nuclear goal plans more seriously. For investors, this matters because India represents a potentially massive new source of uranium demand. Turning ambition into reality will take time, but this legislation is a necessary first step towards that outcome. In our equity segment this week, Denison Mines announced that it is ready to make a final investment decision and begin construction at its Phoenix in situ recovery uranium project in Saskatchewan, pending final regulatory approvals expected in the first quarter of 2026. Phoenix is part of the Wheeler River project and is one of the highest-grade undeveloped uranium deposits in the Athabasca Basin. Denison has spent years advancing engineering, permitting, and project planning, and now expects a 2-year construction timeline with first production targeted for mid-2028. The company also released an updated post-FID capital cost estimate of approximately 600 million Canadian dollars, representing a roughly 20% increase from the prior feasibility study after inflation. Importantly, Denison described the project as construction-ready, with no further material revisions expected before breaking ground. If approved, Phoenix would become the first new large-scale uranium mine built in Canada since Cigar Lake. It would also be the first application of in-situ recovery mining techniques in the Athabasca Basin, a method that now accounts for more than half of global uranium production, but has not previously been deployed in Canada. For investors, the takeaway is this. Phoenix is transitioning from concept to execution. In a market where new supply is scarce and timelines matter, projects that are genuinely ready to build stand apart and tend to be valued accordingly.
Before we wrap up, if you haven't yet read Behind the Curve, Understanding When and How the Uranium Market Turns, it's worth your time. It explains the real signals that reveal when uranium prices are about to move, long before the headlines catch up. Order your Behind the Curve white paper at www.uraniumspotlight.com. You've been listening to Uranium Spotlight, your weekly podcast dedicated to the latest developments shaping the uranium fuel market and its role in the global energy landscape, sponsored by PurePoint Uranium Group. While our passion for this sector is undeniable, remember that nothing discussed here should be taken as investment advice. Our goal is to provide a clear and balanced view of the factors influencing uranium prices. Join us again next Tuesday for Uranium Spotlight.